Welcome back, everybody. After my last video talking about the valuations of AMD versus Nvidia, I got a couple questions asking why the numbers for AMD were different on other websites. And I thought this is actually a really great topic for a video because it is kind of confusing. So in this video, we're going to walk through the AMD valuation example, explain why these numbers are different in the first place, and then break down what it actually means for us as investors. So let's go ahead and get started. Now, first off, let's take a look at what the issue actually is. So in my video, I showed AMD's projected price to earnings as 89 and their projected earnings per share growth as 12%. And a couple people asked me about this in the comments, like, why are you showing these numbers? Isn't AMD's forward PE actually 24 according to FinViz and Yahoo Finance both? Well, let's actually take a look. Now, on FinViz right now, it shows AMD's projected price to earnings as 23.92. And if we look at Yahoo Finance, it shows their trailing PE as 106 and then their forward PE as 24. So what is actually going on? Why are they different? And which one is correct? Now, spoiler alert, they're all technically correct. It's just a matter of understanding what they're telling us and what numbers are using. But let's go ahead and walk through it together. Now, I'll start out by saying that the numbers that I showed in my previous video were directly from Seeking Alpha. I didn't make them up or calculate them myself, and that's the tool I use to do my research, so those are the numbers that I tend to look at. One of the things that I love about Seeking Alpha is that each of these metrics has a detailed explanation of what it's actually calculating so that it makes it easy for us to understand what we're looking at. So in this case, the projected price to earnings is simply the last close price divided by the next fiscal year consensus estimate for GAAP earnings per share. And then if we go over to FinViz and compare what it says there, it says forward price to earnings next fiscal year, but it doesn't actually specify whether it's GAAP or non-GAAP. And in this case, that's actually the difference between the numbers because Seeking Alpha is using the GAAP earnings per share estimates while FinViz and Yahoo Finance are using the non-GAAP estimates. But not only that, it looks like the fiscal year they're using is also different between the sites. And here's how we can figure that out, because even on Seeking Alpha, they have this info. If you go to earnings and then earnings estimates, you can clearly see that for 2025, the earnings per share estimate for AMD is $5.02. And if we just take the current price of AMD in this moment of $118.88 and divide that by the $5.02, then you get a projected price to earnings of 23.68, which is right in line with what you saw on FinViz and Yahoo Finance. But even when you look at Seeking Alpha for their non-GAAP projected price to earnings, it comes up as 35. So why is that? Well, if we look at the earnings estimates again, we see that fiscal year 2024 still hasn't completed for them. But if we use that estimate, the projected PE is actually 35. So it looks like Seeking Alpha is taking projected earnings as fiscal year 2024 since it's not yet complete, while FinViz and Yahoo Finance are taking projected earnings from 2025. So it can definitely be confusing if you don't know what year of earnings estimates you're actually looking at on top of the difference between GAAP and non-GAAP numbers. So at this point you might be asking, well then why is Seeking Alpha using the GAAP estimates and what even is the difference between GAAP and non-GAAP earnings per share? Well, let's go ahead and break that down. Now, GAAP stands for Generally Accepted Accounting Principles, and they're a standardized set of accounting rules for publicly traded companies in the US. And they were created after the 1929 crash to ensure that financial statements were complete, consistent, and comparable. So for us as investors, it gives us the opportunity to compare companies against each other and still have kind of a level playing field as it relates to accounting rules. But the challenge is that sometimes companies do things that kind of screw up their earnings from time to time. And maybe they make an acquisition or have a one-time charge that's not really going to repeat again. And so if you're trying to understand the core operating trends of a company, it can make it a little bit hard because the earnings will fluctuate. So that's why companies also provide a non-GAAP version of their financial metrics, which basically excludes things that they determine as not material to their ongoing operations. And the key point here is that the company gets to decide what's included in that non-GAAP number, or maybe better said, what's excluded. And so you can't really compare non-GAAP numbers across companies unless you manually verify that they're actually looking at similar things. Now, let me show you what I mean. Each company will provide a GAAP to non-GAAP reconciliation document that will show you what is excluded in their non-GAAP number. So if we take a look at the most recent NVIDIA earnings, we can see that for the quarter, they added back stock-based compensation and acquisition-related costs of a little over $1.2 billion. So when we look at their GAAP net income versus their non-GAAP net income, it's $19.3 billion versus about $20 billion. And we can see the difference in their earnings per share number of 78 cents from a a GAAP perspective to 81 cents on a non-GAAP perspective, which ultimately ends up being about a 4% difference. Now, I do think it's interesting that they put stock-based compensation in there because other companies like, say, Visa don't really do that, but then again, they don't have as much stock-based compensation either. So it's just another example where companies really have some leeway in terms of what they include or what they exclude from their non-GAAP number. But still, in NVIDIA's case, it's pretty easy to see that the GAAP to non-GAAP difference isn't really all that material. So using either one as an investor isn't really going to change much. But now let's take a look at AMD. Now, in AMD's most recent quarterly earnings release, they show that they are accounting for stock-based compensation, amortization of intangible assets, and acquisition-related costs in their GAAP to non-GAAP conversion. And so what happens is you have a net income go from $771 million on a GAAP basis all the way up to $1.5 billion on a non-GAAP basis, which is a difference of over 95%. And from an earnings per share standpoint, you go from 47 cents on a GAAP basis to 92 cents on a non-GAAP basis. And so the question you have to ask yourself as an investor is, do you care about this? Do you think it's a concern? Is it important to you that stock-based compensation and a one-time acquisition cost is making up that much of the non-GAAP earnings per share number? Because when they look at future non-GAAP earnings estimates, they're including those things going forward or similar things like that if they happen. And so if we just go back to the original numbers, it's obvious that the reason why Seeking Alpha's projected price to earnings is so much higher than FinViz or Yahoo Finance is because they're using the GAAP earnings per share estimates and not the non-GAAP estimates. And there's a big difference between the two. All right, so now that we know why those numbers are different, let's talk about what it actually means to us as investors. Now, the first thing is something I talk about all the time. Different people or different investors look at different things. So there's no one valuation for a company or one growth metric that always works or one anything metric, because every individual investor, hedge fund, or pension fund is going to use the metrics and things that make the most sense to them. Now, in some cases, people may want their projected price to earnings based on GAAP numbers only because they want it to be standardized. In other cases, people may want it based on non-GAAP earnings estimates because they think it's a more accurate way to gauge the company's performance. And then in yet other cases, people may not even really use price to earnings because they think price to cash flow is a better measure. And in general, I actually fall into that category because I tend to use operational cash flow way more than I do earnings. But I'll still look at earnings because I know that other people do. So I know it sounds like I'm just making things more confusing, but here are the things I think we can take away from this. Number one, make sure you understand what you're actually looking at when you're using these valuation numbers. Make sure the projections are based on the same timeline, meaning does it include numbers for the next fiscal year only or maybe the next 3 to 5 years? Because that's going to skew your comparison. Make sure you know if they're based on GAAP earnings or non-GAAP earnings, and make sure for the companies that you're evaluating what is included in those non-GAAP numbers and are they a concern for you. And then takeaway number 2, use the numbers that make the most sense to you based on your own strategy and criteria and what you think is the best way to evaluate a company. And honestly, there's no specific way for me to tell you how to do this. I mean, people use all kind of different things. And for me personally, I tend to focus on operational cash flow. So I use price to cash flow and projected price to cash flow as my primary valuation metrics, but I also combine them with operational cash flow growth. So that way I get an idea of how much cash the company is generating and how much growth in that cash they're experiencing and projecting for the future. But what you might notice is that I don't really focus that much on free cash flow, meaning taking out the capex from the operational cash flow, sometimes the stock-based compensation. Now, I'll definitely look at those things, but I don't focus on them as much as other people do. And there's no reason for that other than that's just the way I like to do it. Now, I will look at earnings and other valuation methods just to see where they're at, but mostly I focus on operational cash flow. So for you, it might be free cash flow or maybe earnings or earnings growth or any other combination that you can think of, and that's okay. And then lastly, takeaway number 3, don't be afraid to experiment. Just because you used a certain metric in the past doesn't mean that you can't evolve over time. Or even if you have different types of companies where earnings or even cash flow may not really make that much sense, feel free to use what you think is the right way to measure progress and success of the stocks that you're invested in. And contrary to what people say online, there's no one right way to do this or one right way that always works. So feel free to experiment. Look at things, look at different valuation metrics, maybe look at them over time to kind of see if there's any patterns that make sense with what you're looking for in your stocks. So the answer to the question of which one of these forward price to earnings ratios is the correct one for AMD is, well, they're both correct. It just depends on what you're looking to see, which I know is probably the least popular answer ever. Now, I'm curious, whenever you guys do your valuation methods, do you have a preference for GAAP or non-GAAP numbers? I would love to know down in the comments below. If you want to know what business trend I think is going to be the biggest in 2025, you can check that out by watching this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you on the next one. Peace.